Hello, everyone. So we're going to start getting into financial statements, and this is both an overview and an extension. We're going to look at both the balance sheet and the income statement on this next batch of material for your second exam. So we start with the balance sheet, and I call it capturing a moment in time because every balance sheet is stated at a particular date. And that's because we're assessing the level of all of these items at that date. The balance sheet has a very particular order. All of these items appear in this order for current assets. When we list the long-term assets outside of current assets, these also have a particular order. And all of this is ordered in what we would call liquidity. Liquidity is the ability to convert into cash. So what we're trying to get with this ordering is how quickly can the company marshal together its resources in order to convert these items into cash. That's the asset side. Now, that's typically sometimes called in industry the left-hand side of the balance sheet. The right-hand side consists of our financing. So what liabilities did we take on in order to acquire these assets? What ownership is in the company that might describe how we had the money and the funds to purchase these assets. So we start with liabilities. We list all the current liabilities first, and then we list the long-term liabilities, which can be more than bonds, but this is the most important and most typical. And then all of the items that can appear in equity. So understand this is the template of a balance sheet. Most companies will stack them, right? They'll just put current liabilities right under all this and keep going. But I do this in order to show you left-hand side, right-hand side. And it also correlates to the accounting equation where we have assets on the left-hand side and liabilities and equity on the right. So before we get into the specific accounts, we really need to cover some common valuation terms because our extension in the balance sheet isn't going to be just classifying a particular account as an asset, liability, equity, and further as current or long-term, and the classifications within each, but more an appeal to how do we measure it on the balance sheet. So book value will be something I say a lot in class. And it's just quite literally, what is the dollar value that is listed on the financial statement? So what is the value that we find when we look at the company's books, right? You can replace books with financial statements. That's what book value means. So when I say book value, it's referring to these dollar amounts that we would find on the balance sheet. Now, net realizable value is another term that will come up a lot in this class because it appeals to the book value of certain current assets. So what that means is net realizable value is a type of book value. Right? It tends to be what we use for receivables and inventory. And that's also going to be two major topics in this course. Fair market value is technically, right, the price at which two parties are willing to conduct a transaction in an orderly market. And more simply, it's the sale price, right, determined by a market that's active. Because typically we want to have a lot of buy and sell. We want to make sure that the price is on point because a lot of people are agreeing on buy prices and sell prices. We don't want to have an asset that is not on an active market because then those prices might be a little biased. So when I talk about fair market value, just think about what could I sell this asset for? This can also be the book value of certain assets, not just the current ones, but there are a few currents. And most notably, investments tend to be at book value. I'm sorry, fair value. Their book value is fair value. I forgot the word value here. Book value of certain current assets. Of course, cash is at fair value because I could sell a dollar for a dollar any day, right? Cash is fungible, it's exchangeable at its particular values. Another term that I want to get you familiar with is recognition versus disclosure. Now, this is pure accounting terminology. Recognition happens when we change what we're listing on the balance sheet or the income statement or any of the financial statements. So it changes the manner in which the item is listed on any financial statement. So the financial statements are the high-level summary of an annual report. They are the 4 to 6 most looked at pages in an annual report, right? The annual report has 100 pages or more sometimes, but these are the place where we go to find the overall summary of how the company is doing. The change could be qualitative, which means not numbers. So we might just separately present information. For example, there might be something, and we'll talk about it here in a bit, that would cause me to break off cash and cash equivalents into 2 line items. A line item simply means here's cash and cash equivalents presented as 1 line item, marketable securities is the 2nd line item, and so on and so forth. We might have a certain restriction on cash that causes me to present cash and cash equivalents, and then right below it, restricted cash. So that would be a qualitative change. It also may be quantitative, which means it's going that when I recognize a transaction or I recognize something that occurred, it'll change the dollar value I reported for a particular asset, liability, or equity item. This is in opposition to disclosure. Disclosure is a way for us to signal information that is not on the financial statements. They're presented in the footnotes to the financial statements. And this would be considered a lesser impact to investors and creditors. This is where I tested these pins. So when something's recognized, it tends to have high impact because these are the most looked at items in the annual report. Footnotes, on the other hand, they can be dense. They can be many pages, somewhere between 20 to 40 pages in length. So you have to sort of read and dig and really know what you're talking about and really understand accounting in order to get at what's going on in the footnotes. Hence, when something's disclosed, it's not ignored, but it can be harder to find. When something's recognized, it is front and center on those main pages. All right, so that's the vernacular we're going to go with here for the balance sheet. Now, let's dive in. Current assets. The definition of a current asset is something that we are going to turn into cash, sell, or consume within a year or an operating cycle. Now, this year is going to be your typical measuring stick. However, there are some companies that will have current assets that are not going to be consumed within a year. In that case, they appeal to the operating cycle. So let's turn to that for a second and understand what the operating cycle is. The operating cycle is simply the time it takes from me putting money into operations, so buying inventory, paying my employees, paying all of the things that keep my company running, selling a product or a service, and then collecting money. So there are certain types of businesses where the operating cycle will not occur within 1 year. What might that be? If you think about industries that have larger discrete projects. So the timetable on them finishing something is beyond a year. Or maybe they have inventory that is very niche, that they have to find just the right buyer, right? These are large priced items that they need to find someone who really wants it. So industries like that, defense contractors, commercial real estate construction, jewelers, right? If you think about Tiffany's, that jewelry is not flying off the shelves. They might have a piece of jewelry there that has been sitting there waiting for the right person to come along and purchase it, and it could have been there for a year or more. Okay. Compare that against the common retailers that we're more familiar with, the grocers, apparel stores. Those definitely have an operating cycle within the year. So these guys are a year of an operating cycle because they are shorter than an operating cycle. Anything shorter than a year gets bumped out to a year. That's the definition of current asset. And then these guys that take longer to complete an operating cycle, well, their current assets might take longer than a year to be sold. Again, in our class, we'll typically assume within a year, but just so you know, there are companies that can have inventory that takes longer than a year to move. It's still a current asset. As I mentioned, individual assets always presented in order of liquidity. So only banks do not have a distinction between current and long-term assets. That's a peculiarity in an industry. Let's start with the first current asset. And it's the most liquid because it's already in cash or it's just about to be cash. We'll explore more what cash equivalence means in a future chapter. But for now, understand what's in there, right? The definition is any paper currency, savings and checkings accounts, money market accounts. The equivalent portion of this is going to include very short window investments. So things that will pay off within, say, 90 days or sooner than that. That's the equivalent part because it's not cash, right? We bought a treasury bill. We allowed another company to borrow money, but we are going to get that money back within 90 days. So the measurement, it's fair value. Like I mentioned, $1 sells for $1. Now, one thing about cash and equivalents that we have to clarify is that sometimes cash can be legally restricted with specific purposes. And when that happens, it is recognized, right, as another line item on the balance sheet. So we change the face of the balance sheet. We change one of our financial statements when cash of a certain amount is legally restricted. This could be, for example, if the most common example would be when we borrow money. And part of the terms of our borrowing is that we have to set aside a certain amount of money in a bank account somewhere that we do not spend. It's restricted from our use. And if it becomes restricted from our use, it is no longer liquid. So it no longer meets this definition of cash and cash equivalents. If the restriction is short term, then it's going to remain current. So we'll see something along the lines of that second line item being created, cash and cash equivalents for an amount of money. And then right below that, if it's short term, if it's going to expire within a year, well, it's not cash and cash equivalents because cash and cash equivalents to flags a financial statement user to tell them, hey, this is cash I could spend whenever I want. This now tells me, well, there's some cash that's not available currently, will come available in the current year, but until then, it's not free and clear to use. And then the rest of my current assets, as you saw on the front page, will follow marketable securities, et cetera, all the way down. If those restrictions are not short-term, right? If it's short-term, we still include it in current assets. But if it's not, Then we'd have all of our current assets, including the unrestricted cash and cash equivalents. And then we total them out. And it would be classified as a long-term investment. So if we think about the general category long-term investment, which includes many things other than restricted, long-term restricted cash, but that would be one of them, because now we're informing people, yeah, we do have some cash. It's tied up legally, right? That's a big distinction. It has to be legally bound, where we absolutely have no choice but to not touch it. It's tied up legally for longer than a year. So we don't, while it is a cash amount, it is not available for my use. Okay. If it's not a legal restriction, then the requirement isn't as severe. Separate recognition, as we did here, bringing it down into another line item, is not required. And the amount can be included in my first item, cash and cash equivalents, but we have to disclose in a footnote. So that's an example of that difference in treatment from an accounting perspective. When it's a legal restriction, we have a rigorous treatment. We totally separate it out from cash and equivalents. We list it as either a separate current asset or a long-term asset, depending on the dates of the restriction. But when it's not legally restricted, when the company is setting aside funds, has future goals for expansion, then, and it's still just cash, we don't have to separately disclose any, we don't have to separately recognize anything, but we do have to mention it in the footnotes that the company is holding cash aside that is not legally restricted. The second major class of current liabilities is marketable securities. So marketable securities is just a generic term for short-term investments. In fact, that is another term that you might see sometimes on some balance sheets. There's no favored term. I've seen both in different places. So these are items that will become cash or sold within a year, right? Within a year or an operating cycle. Typically, it's me investing money in other companies' stocks and bonds. So we can invest in other companies' debt, right? So if I am a lender, and over here, the borrower. When the borrower borrows money, we call it bonds payable. When the lender buys those bonds payable, we call that an investment. And that investment can be specifically called a debt security. So when I, as a lender, buy another company's bonds, I am giving them my money. In return, they will pay me interest and principal over time. And that's how it is an investment. Because while I allow them to borrow $1 million, the promise this borrower makes is, well, since you allowed me to borrow that cash, I will pay you interest and principal at the end of the arrangement, and you will get a return on your money. Understand that we don't just borrow money from banks. Companies will borrow money from banks, from other companies, from issuing bonds on public markets so that anyone can invest in it. If you have a 401k, you are invested in some bonds and not just from the government. Investments in other companies' stock are called equity securities. So that's a different type of short-term investment. When one company decides, I want to buy a portion of the common stock of this competing company, and that happens a lot. And particularly in the automotive industry, Chevy is highly invested in Ford and vice versa. They buy each other's stock and hold it. And the big difference between investing in debt and investing in equity is when we invest in debt, we're looking for fixed payments of interest and, of course, our money back, right? We don't make any money off of allowing someone to borrow $1 million just to get a 1 million back. So really what we're getting as a return is those interest payments that the borrower is making to us over time. When they're equity securities, right, we're buying the common stock of another company. So instead of a lender-borrower arrangement, we have an investor who isn't just a person, it can be a company, right? Companies will invest in each other's common stock. And really, I have no better term than to say investee. So this is the person who's purchasing ownership. They would call that an investment in equity securities. The investee would show this as common stock. So a very simplified journal entry would reveal something like this, where the investor has an investment debit, which would increase its asset account. It would credit cash because it paid cash in order to buy that common stock for whatever price we're talking about. The investee, right, the counterparty to this, would debit cash. So this is two separate companies' financial statements or accounting records. And of course, they would credit common stock because they issued stock to this particular person if this were a new issue. And they would also credit APIC common stock for anything above a par value. So it's good to understand exactly these different transactions and what they mean to each person. If I was to do this above here, the borrower would record something along the lines of receiving cash and crediting bonds. I'll add the payable on it because that's more of a technical accounting term. Payable, very high level technicality. They received cash and they also now have an obligation, whereas the lender is paying cash and they are creating an investment. So the investment to the lender is an asset. And of course, they have to pay out cash in order to procure and acquire that investment. It's good sometimes to look at these party counterparty journal entries to understand the symmetry of accounting. Right? That cash is always perfectly reflected in that a credit to the one party is a debit to the counterparty, that an asset here that's an investment to this party to the counterparty is a bond payable when we're talking about a debt security. Right? Over here, this asset to the investor is an investment. Of course, a credit to cash because they had to buy into the common stock of the company. And if this were a new stock issue, then the person who received the funds from their new investor would debit cash and credit equity accounts as they issue new stock. We will talk about the further classification of investments in class. It gets a little tricky, but this is, I think, one of the best ways to highlight how we value different things on the balance sheet to be most relevant to financial statement users. So bring this table to class, bring all your notes to class, of course, every time, but we will talk a lot about this piece in particular. The third type of current asset, and I'm going in order of liquidity, is accounts receivable. So this is when customers owe me money. What is the measurement of accounts receivable? It is net realizable value. Their book value is net realizable value. So what we anticipate collecting. I didn't mention it before, but understand that whenever you see the word net, that means something has been deducted from the amount. So we've subtracted something off from the amount that we're reporting. And that something just depends on what item we're talking about. So what net realizable value represents is the total debit balance of accounts receivable. So if I think about my ledger account for accounts receivable, it will have a debit balance because it's an asset. And then we are going to remove allowance accounts. These allowance accounts, the one that you're most familiar with is the allowance for doubtful accounts. And I can't fit it all up there. Right, the allowance for doubtful accounts. This is a contra asset. Remember from module 2, contra assets have the opposite balance of their account that they are associated with, and we keep them separate in our ledger, in our book of accounts that has all of the items that affected accounts receivable, all of the items that affected the allowance for doubtful accounts. We bring them to a balance at the balance sheet date. And then when we report them on the balance sheet, it would be reported as accounts receivable net, basically the dollar value of accounts receivable minus my allowance for doubtful accounts. This would be a balance sheet disclosure at whatever date we were preparing the balance sheet for, constructed from two balances that were the balance of these accounts at that date. So that's how we report accounts receivable. Subtracting off any allowance that is a contra asset to this primary account. Inventories, right? The definition of an inventory is something that we intend to resell in the ordinary course of business operations, right? So something we buy with the explicit intent to resell. They are valued at the lower of cost or market value. And what that means is we might have bought that inventory at $10, but if we can only sell it, right, because market value means the sell price, if we can only sell it for $7, then we need to lower that value we have on the balance sheet to $7 because it's the lower of the two. And this is an application of conservatism, which was something that I talked about in the first module. When two estimates are equally feasible, we take the one that will understate assets. Okay. So doesn't matter what we bought it at. We normally want to carry inventory at its cost, the cost to make it, the cost to acquire it. But if that value becomes greater than what I can sell it for, then we have to lower the value to the value that we can sell it for. Now, you might be thinking, wait, what about the prepaids and the supplies? Because we made a big deal about those in intro in the first part of this course. Well, this is just assets we throw into an other category, other current assets. And so it's a catch-all for things that we are going to liquidate within a year. The two most common are supplies and prepaid expenses. Prepaid expenses can have other names to them. I will use prepaid expenses. We report the unexpired cost, the amount that's still remaining. You remember that hopefully from your journal, from your adjusting entries. Understand that if we pay for multiple years, then any amount that is beyond the next year will be reported as a long-term other asset. Okay, so we only want to put in other current assets the amount of the prepaid contract that will be used within the coming year. Finally, and we'll touch upon this again when we hit PP&E, if PP&E has been retired from operations and being held for sale, if we're holding it for sale, part of the criteria to list it as held for sale is that we believe we're going to be able to sell it within the year. And of course, we have the intent to sell it within a year. So it is no longer PP&E. It is no longer equipment. It is no longer land. It is no longer a building. It doesn't go down there with those other long-term assets because we're going to sell it within a year. And I will go ahead and put that down just to kind of keep it in your head. To be classified as such, there must be an intent and ability to sell within a year. That'll help you understand and remember that, hey, this is going to get converted into cash within a year, so it has to be current. Those are the current assets of the balance sheet. I would make an exercise of writing them out. First, just get their ordering. To understand their liquidity, cash and cash equivalents, marketable securities, accounts receivable, inventory, and other current assets. Because remember, always these need to be listed in order of liquidity. And as you get more proficient with these, more familiar with them, also their value. Cash and cash equivalents are fair value. Marketable securities, always fair value. Accounts receivable are at net realizable value. Inventory is at lower of cost or market. And other current assets, I'll just say it's mixed. And this is their book value. This is the value we find on the balance sheet for each of these.